So welcome back everyone, this is Mayank Kothari. Today we are going to start a new chapter, that is security valuation. This is going to be the fourth chapter. I'm assuming that the first, second and third chapters and fourth chapter's theory has been completed by you by this time. Okay. So security valuation is going to be one of the biggest chapter as it has 131 questions in our compiler. So don't get just worried about the number of questions, because there are few questions which are just there in the syllabus for the conceptual clarity. And I will inform you about the number of questions which are not at all important from the exam point of view. That means, let's say for example, there are two questions on the similar concept. The first one is very easy and the second one is very tough. Okay. So if I'm going to, we will go through both the questions in this fast track batch. Okay. But later on I will tell you that don't mark the first question as important, just do it with the second question. So if you are revising the second question on and on again and again, then automatically it covers everything from the first question. So there is no need to even look at the first question after this batch. So that ways we can reduce the number of questions for you to practice by around 30 to 40. Okay. So it will come down to somewhere around 70 questions. That's okay. Security valuation is a practical chapter. Let me tell you this thing first. And anywhere between 10 to 20 marks of the question can be asked from this chapter. There are many things in this chapter that we are going to learn. But first, understand the meaning of the chapter. The third chapter that we learned in the previous lecture was security analysis. That means we were analyzing the security and estimating the trend of that security in the future, whether that security will go up or down. Accordingly, we will take the decision that if we want to buy the share, we will do it in the bullish market. If we want to sell the share, we will do it in the bearish market. In security valuation, we are going to calculate the theoretical price of the share. Let's say for example, the theoretical price comes down to 100 rupees. Okay, let me start this thing. So let me just go through it. Security valuation. What is going to happen? First of all, let me talk about the securities. There will be different types of securities we will be learning in this chapter. The first one is called as equity. The second one is called as preference shares. The third is the bond market. And the fourth one is the money market. Money market was not there 2 years back in this chapter, but later on it was introduced by the institute, and that's when the number of question in this chapter shoot up to 131. Okay, so we are going to value all these securities. Now comes down to the valuation part. What is going to happen with this? We are going to value the securities. Let's start with the equity part first, and let's say we have a share of Tata Motors. There are two things for the Tata Motors shares. Whenever an investor will go and decide what to do with the Tata Motors, there will be three types of decision that he will take. The first one is whether I should buy the shares or sell the shares or hold the shares. See, someone who does not have the shares, he will decide whether I should buy or not. A person who already has the shares in his demat account, he may decide to buy further more if it is available at a cheaper rate, or he may decide to sell the one that he already has, or he may decide that it's okay, let's hold the shares that we already have and do not buy and sell for the time being, because the market prices are like that. But all these decisions are taken based on the market price of the share. Now, these decisions will depend on two parts: actual market price, which you can get from the stock exchanges, actual market price of the equity, which you can easily obtain from the stock market. You can Google it and you will get to know about the current market price of the share. Let's say for example, the current market price is 100 rupees. for the simplicity. So if you want to buy the shares of Tata Motors, it is available in the market at 100 rupees. And then what happens? You do all the theoretical practice at home. You bring out the theories by different people which has been evolved and explained in the past, and you apply those theory on this share and you come down to a certain figure that is called as theoretical market price, which has been obtained by applying a certain theory on the data. So theoretical market price, let's say for example, comes down to 120. What does this means? This means that actual market price is lesser than theoretical market price. And the meaning of this, let's interpret. According to me, means the investor, the share of Tata Motors should be available in the market at 120. So the word that I used is should be. It should not be more than 120. It should be available in the market at 120. Okay. So the fair price that I am considering for this share is 120. But when I go to the market and look at the price of that share, I come to know that it is only available at 100 rupees. Actual price, real price, buying price, selling price, whatever you want to say. The transaction price is 100 rupees. If you want to do the transaction on this share, you are going to do it in the actual market. This is just a theoretical price which you have calculated based on your theory. Okay. Now come down to this 100 rupees. Now tell me one thing. A particular share which should be 120 rupees in the market is available in the market at 100 rupees, means at a price lesser than your expectation. You were ready to buy the share at 120 rupees maximum, and if it is available at 100 rupees, whether you are going to buy or not, yes sir, we are going to buy. Why we are going to buy? Because we will say that this 100 rupees share is undervalued. I will just write it down here, undervalued. What do you mean by undervalued? Proper valuation is 120, and if it is available at a lesser price than that, we will say it as undervalued. The share is undervalued. The valuation happens on the actual market price. And if a particular share is undervalued, we will say that it is available at a cheaper rate, and a cheaper rate per product should be bought by a person or an investor. We should buy a cheaper investment which is called as undervalued shares. Why? Because actual market price is lesser than theoretical market price. Let me just take an example. This is a mouse. This should be available in the market. According to me, this is a Dell mouse and it should be available in the market at rupees, let's say for example, 500. When I go to a particular shop, a computer shop or Amazon or something like that, I found that this is available only at 300 rupees. My expectation or my fair price for this product is 500 rupees and it is available at a lesser price. Whether I should buy the mouse or not, obviously I should go and buy the mouse because I am getting it for 200 rupees less price than what I was expecting. So this is undervalued at that time. Okay, let's just repeat the question. Let's say for example 100 rupees is the market price, and you have applied all your theories and you came to the conclusion that the market price should have been 80 rupees. Now according to you, this share should have been available in the market at 80 rupees. When you went to the market to buy the shares, you saw that the share is available at 100 rupees, which is more than your expectation. Just imagine one thing, that you expect that you want to buy the classes of SFM and you expect that somewhere around 5,000 rupees you will pay for the fast track batch. When you go to the actual market, means conferenza.in, and you saw that the class is available at 7,000 rupees. Your expectation was 5,000. It is available at a more price, at a bigger, or we can say a larger price than your expectation. Higher, a better word is at a higher price than your expectation. What you will do? Will you buy the class? If your expectation is 5,000, that means I am assuming or everyone is assuming that your budget is 5,000 only. You cannot spend more than 5,000. At that time, you are not going to buy the class. So same is with this product. 80 rupees of the product is available in the market at 100 rupees. It is available in the market at 100 rupees. The actual price, the transaction price of the share is higher. We will say it as overvalued. Again, the valuation is decided based on the actual price, not the theoretical. We will say it as costlier. And at that time, you should not buy the share if it is available at a higher price. Although there is another side to this, which says that if you have the share already and you think it is only worth 80 and someone is ready to buy in the market at 100 rupees, you should sell it. If the market price for this product is 100 rupees, you should sell it. I will tell you. I have the mouse already. I might have purchased it for, let's say for example, 250 rupees or 300 rupees, right? Now after 3 years, I saw that the same mouse, okay, it's in working condition right now, perfectly working. Okay, the same mouse in the market is available at 1,000 rupees. I saw the opportunity, and I cleaned that product, okay, packed it into a particular box, okay, and then listed on the Amazon at 800 rupees itself. Still, it is at a higher price. Anyone will buy it as compared to 1,000. But for me, it was only for 300 rupees. And I'm selling it at 800 rupees and people are buying it. I should sell it. If I'm able to sell a product at a higher price than my expectation, I should sell it. So in this question, 80 rupees was my expectation for this share, but it is available at 100 rupees. Sell it. You will have a profit of 20 rupees. This is called as overvalued. Last condition. Let's come down to last situation. 100 rupees is the price, actual price, and your estimated or theoretical price comes down to 100 itself. At that time, you will say that whatever I am expecting, it is available in the market at the same price. What you should do at this time? We will say that this product is correctly valued. Isn't it? Correctly valued. And this is correctly valued. That means you should hold the share if you have, or hold your decision. If you want to buy, you can go for that, but hold your decision. It may go down to undervalued condition or overvalued condition, and then you can take the decision. But for now, the prices are similar, so hold your decision. Tomorrow, either it will go up or down, and then you can take the decision. So this is what undervalued, overvalued and correctly valued means. All this valuation depends on the actual market price. If it is higher, overvalued. If it is lower, undervalued. If it is equal, correctly valued. Undervalued shares should be bought, overvalued shares should be sold, correctly valued shares should be held. Okay, so this is the basic meaning that we completed. We started from this point, security valuation. We saw that there are different types of securities that we are going to learn: equity, preference, bond, and then money market. After that, we came down to the second word, which is valuation. In that valuation, we saw that we are going to decide, an investor is going to decide whether to buy, sell, or hold the share. In order to take the decision, he needs two prices: actual market price and theoretical market price. Actual market price is very easy to obtain from the market. Then comes down to the next part, which is theoretical market price. Now the question is how to calculate these prices: 120, 80 and 100. This is obviously easy to obtain, but the question comes to this point, that how to calculate the theoretical market price. There are different types of theories that we are going to learn in the coming time. The very first theory to calculate the price is Walter's model. Then comes the Gordon's model. Even you have seen the P ratio approach. Do you remember the market price? Theoretical market price is calculated by EPS multiplied by P ratio. This is also one of the ways to calculate the price. Okay, and discounted cash flow methods. There are many things that we are going to learn. These are the theories that we are going to learn in this chapter. By learning this theory, we are going to calculate the theoretical market price. Now I'm going step by step. Okay. So first step is to understand the theory, understand the formula, apply it on the given data, calculate the theoretical market price. Second step, compare it with the actual market price. Third step, take the decision accordingly, buy, sell or hold. Fourth step, that's it. This is your decision. Ultimately an investor wants to take the decision. Rest of the things will be taken care by the market, profit and loss and everything. We have to come down to this part, and for this we have to learn all these theories. Okay, that's great. So this is our chapter that we will be starting now. Security valuation. Okay, one thing that I should tell you is that whenever you start a chapter, please make sure that you are revising the chapters, revising all the chapters which has been completed till now, till a particular lecture, through charts and formula book. Just once you should go through it and then come down to this part. Okay, security valuation is the next chapter. For the sake of our understanding, we are going to just go through the formulas that we have seen. First formula was simple interest, principal into rate into time. Compound amount is P in bracket 1 plus rate of interest per annum divided by number of compounding in a year to the power number of compounding in a year into time in year. Effective rate of interest. This formula comes from the same formula, 1 plus r divided by n to the power n minus 1. Future value, present value, the formula is same as compound amount. This is compound amount, this is principal. Rest of the formula is same. This is called as present value factor. Present value factor is nothing but 1 divided by 1 plus r to the power n, or we can say 1 plus r, and then if you press equal to, you will get the present value factors of every year. Then comes the annuity. If a certain figure is repeated every year, you can calculate the present value of that figure by taking it only once and adding all the present value factors and multiplying that annuity factor with this single figure to arrive at the present value. The last concept was perpetuity. If a particular cash flow is repeated at a particular rate of return, say I'm just repeating this. If I'm earning this much of the cash flow every year with this much of the rate, then I will have to invest this much of the amount today to receive that much amount. So let's take an example. If I invest 1000 rupees at 10%, I will be getting 100 rupees every year. So 1000 multiplied by 10% will give you 100. 100 divided by 10% will give you the current investment that you want. Now this same concept will be used in our next security valuations first formula. Okay, I will talk about it later on. Now comes to the second chapter, risk management. The first formula that we learned in the risk management is calculating the z-score, which is nothing but x minus mu divided by standard deviation. If you remember that question, x was minus 1. We had to reach at 1 crore of the loss, and we started from the mean, which was 2 crore rupees of the profit, and every standard deviation was of 1.6 crore. So the figure came down to 3 minus 3 divided by 1.6. Then we arrived at the z-score 1.875 something, and we calculated the probability of that 1.875 in the table, and we came to know that the left side of that entire part comes down to 3.04%, the right side comes down to 96.06%. What does that mean? That 3.04% is the probability, the chances that my loss will be at least 1 crore, and 96.06% are the chances that my loss will be maximum 1 crore rupees. You got that? Then comes to, okay, then what happened is that standardize a normal variable. Now we use the same formula for calculating the VAR, because VAR is nothing but the amount at which we have to reach. So we took X as the VAR, And whenever we want to calculate the VAR, we starts with a mean of 0. We start from the mean of 0. So this formula becomes like this: Z is equal to VAR minus 0 by standard deviation. If you take the standard deviation on left hand side, the formula will look like this: VAR is equal to Z score into standard deviation. Then standard deviation for multiple days can be calculated as standard deviation of 1 day into under root t. So if you want to calculate it for 10 days, take it under root 10. Okay, this will give you VAR of 10 days. Now this part, Z score into standard deviation of 1 day, is also called as VAR of 1 day. So if you want to calculate VAR of 10 days, you just simply can take VAR of 1 day into under root 10. Standard deviation of 1 day into under root t will give you standard deviation of t days. Okay, then comes down to portfolio variance in currency. If you remember, if it is in percentage, we will have to use the weights. But if it is in currency, we should not use the weights. So variance square, that is standard deviation square, is equal to standard deviation of the first investment square, second investment square, plus 2 into standard deviation of first investment, second investment, and correlation coefficient of AB. Then portfolio variance. Portfolio variance is the same, it should be calculated in the same manner as we calculated the portfolio variance. Oh, this is portfolio VAR, sorry. So portfolio VAR of the portfolio square is nothing but VAR of the first security square, second security square, plus 2 into VAR of first security, second security, and correlation coefficient between the two. Also, VAR of the portfolio can be calculated with the same formula, Z score into standard deviation. The only thing is standard deviation of the portfolio should be taken in order to calculate the VAR of the portfolio. So this was all about the risk management. Then comes down to risk security analysis. If you remember, absolute breadth index, the number of stocks going up minus the number of stocks going down. So we took the example like this: 30 stocks are going up, 15 stocks are going down, total number of stocks were 50, 5 stocks were remain unchanged. Okay, so this was our absolute breadth index. Total issues traded means the denominator of 50 was calculated like this: 30 advancing stock, 15 declining stocks, and stocks unchanged were 5. So this way it was 50. Then comes the confidence index. We undertake the bonds here. Best grade bonds, calculate the returns of the best grade bonds and then average of those return. Calculate the returns of the intermediate grade bond, average of those return. Put it in this particular formula, you will get the confidence index. RSI is more of the strength. RSI, relative strength index. It shows how much you can rely on a particular stock. This comes down to your belief in that stock compared to the economy. So percentage change in the index denotes the percentage change in the economy. And stock price means the stock that you're looking into. So if your stock changes by, let's say, 10%, and the stock index also changes by 10%, that means your stock is going according to the economy. But if your stock changes by 5% and the index changes by 10%, that means your stock is only 50% reliable as compared to the economy. Okay, arithmetic moving average and exponential moving average. We learned about the moving averages. Moving averages helps us to understand or estimate the future movement of the stock. So it can go up, whether the market is going bullish or bearish. That is where we want to reach. And moving averages can be calculated by two different methods: simple or arithmetic moving average, and then exponential moving average. Arithmetic moving average or simple moving average is very simple. If you want to calculate 30 days simple moving average, take the 30 days closing prices of a particular stock, add them and divide it by 30. So that is simple average. Total of the closing prices divided by number of observation. But there was one problem in the arithmetic moving average. What was that problem? The reason should be known to you. So that you should remember why we calculated the exponential moving average. The reason, the drawback of the arithmetic simple or moving average was it gives equal weightage to all the prices. Means for simple moving average, yesterday's price is as important as, or at a similar level it was important as, 30 days back price, the price before 30 days. So I don't think so. Practically we should give equal weight to both the prices. The price 30 days before is now not that important for me as the price which has happened yesterday itself. So yesterday's price is more important. We should give more weight to the recent prices rather than equal weight. So exponential moving average came down because of this drawback. Now you can clearly see current price into exponent. This is the maximum probability that you are attaching to a single figure, yesterday's closing price. And then what you are doing is you are adding the rest of the EMA into rest of the probability. Let's say, for example, you are giving 20% probability to current price. That means for rest of the prices you are giving 80% probability in all. So you are giving more weightage to a single price in this case. If the exponent is given in the question, use that. If it is not given in the question, this should be the formula. So if you want to calculate 30 days EMA, 2 divided by 31 should be the formula. Run test analysis. There are three forms. Okay. There are three forms that we learn. Weak form of market efficiency, semi-strong form of market efficiency, and strong form of market efficiency. In order to understand or evaluate or prove the weak form of market efficiency, there are three different tests. First is autocorrelation test that we are going to learn in the portfolio management chapter. Second is run tests that we are going to learn in this chapter. We learned in this chapter. And then filter rules test. Nothing is given on this in your syllabus, but still we are going to see something of it in the portfolio management chapter. So this is the run test. Run test includes 7 steps divided into 3, 2 and 2. First 3 steps are calculating the number of runs where the prices changes plus and then when it comes to minus, first run is completed. Number of positive price changes, number of negative price changes. Using these figures you are going to calculate mean and standard deviation with these formulas, and with the mean and standard deviation you are going to calculate lower and upper limit. You will be given with the t value. For the t value you need 2 things, confidence level and level of significance. Understand this. Okay. So the t value will be given to you in the question. You calculate the lower limit and upper limit, and then this total number of run should be compared with lower and upper limit. If the number of run R lies in between lower and upper, we will say that, please understand, we will say that market is weakly efficient, or the market, the current prices are independent of the past prices. No one can earn extraordinary return based on the past prices. But if that limit does not, if the number of run does not come in between lower and upper limit, that means market is inefficient. Past prices are dependent, current prices are dependent of the past prices. Anyone can earn extraordinary return using the past prices. With this, we'll end our chapter. Explain buy and sell signals provided by moving average analysis. Please go through it once and you will get 4 marks if the theory is asked from this chapter and this question. Then comes down to security valuation. We already have discussed about this valuation thing, overvalued, undervalued and correctly valued. If the actual market price is greater than theoretical market price, it means the shares are available at a higher price. We will say that it is overvalued, and that's why we will go for selling and not buying. If the prices are correct, we will say it as correctly valued, we will hold the shares. If the actual market price is lesser than the theoretical price or should have been price, it will be undervalued and we will go for buying the shares. Then comes down to the first theory of calculating these theoretical prices, that is Walter's model. Now Walter's model explains you about the theoretical market price, and this is the formula for Walter's model. So in order to understand the formula, or unless and until you understand the formula, it won't be an easy thing for you. So let's go and discuss about the formula, Walter's formula. So first of all, Walter's formula is dependent on one of the formula that you have learned earlier, which is perpetuity value is equal to annual cash flow divided by rate of interest. So this annual cash flow is earned at this rate every year, and for that purpose you will have to invest this much amount today. This was the concept of perpetuity, and the same can be applied in our question, which is like this. The value that you will invest in equity share is called as market price, and the amount that you are going to earn every year is called as earning per share. Okay, I will talk about the rate of interest in a moment, but now I will just take a pause here. We will go to a different discussion now. Let's say, for example, this is you. You are giving money to the company. This is you means the investor. This is company. So you have given around 100 rupees to the company, and company will invest this 100 rupees in its business. And that business includes sales, cost, then we can say earning before interest and tax. After deducting any interest, we arrive at the earning before tax. We can deduct the tax also, then we arrive at the earning after tax. Then if there is any preference dividend, we can deduct that. Then we will say earning after tax for equity. We can divide the number of share with this earning after tax, and we will arrive at the earning per share. Okay, out of this earning per share, let's say this comes down to 10 rupees. Out of this earning, we distribute something to the investors, which is called as dividend per share. Let's say, for example, we are distributing 3 rupees. Rest of the amount is called as retained earnings, which is 7 rupees per share. Okay, so this is how the things goes. Okay, now come back to this point. Investor had 100 rupees. You, me, anyone had 100 rupees. He would have invested somewhere else, and he would have received a particular return on that. Let's say, for example, he could have invested in fixed deposit and earned 10%, or some other investment, bond or any other, and he would have earned maximum 10% on that amount. Instead of investing in that place, he put his 100 rupees in this company. The question is, how much minimum he should expect from the company? How much return he should expect minimum from the company? The minimum that he will expect from the company is 10%, because that was the amount that he could have earned easily by investing somewhere else. So the minimum that he will expect is 10%. Below this, it is not a feasible decision for him to invest in the company. Okay, we are good with this. Now, this minimum expectation is called as required rate of return. This is a return for the investor. That's why we call it as required rate of return. But if the company is fulfilling this expectation of the investor, it is going to be the cost for the company. This is also called as cost of equity. And this cost of equity is for the company. So if you read it as a required rate of return, this is 10% from the investor's angle. Cost of equity, 10% from the company's angle. The percentage remains same. This cost of equity was covered by us in CA Inter Financial Management chapter number 3 or 4, I think, which is cost of capital. So in that we used to denote this cost of equity as KE, if you remember. Okay, that's good. Now this is the cost of equity, KE. After that, the company takes 100 rupees and invests in the business. Let's say, for example, company earns around 12% on this investment. This is called as return on equity. And if the company is only equity finance, there is no other financing in the company, we can call it as return on investment also. Why I am telling you? Because investment includes equity, debt, preference, loan, everything. But if we are assuming that these three things are not there, then the entire investment includes equity. So we call 12% as return on equity or return on investment, it is the same thing. Why I am explaining to this to you is that in the coming questions you are going to face this situation where sometimes we will be using ROE to represent 12%, sometimes we will be using ROI to represent 12%, so that at that time you should not get confused. You will have to assume that there are no other investment apart from equity, and that's why equity investment and total investment is same. So that's why we can call ROE and ROI also as the same. Okay. So we will denote this 12% as ROE. Good. Now, the next question. Okay. Can I say that 10% is something that the investor is expecting and 12% is something that the company has earned on investors' expectation, investors' investment? So is it better for the investor or bad? Good or bad? It is good for the investor that the company is earning more than investors' expectation. More than investors' expectation. Now when the time comes to distribute the dividend, investor will say, do not give me anything, because whatever amount you will return to me, I can earn only 10% on that if I invest somewhere else. So if the business is giving back 3 rupees to the 3 rupees as dividend to the investor, this 3 rupees will be taken back as a dividend by the investor, and he can only earn 10% on that. If the company can earn 12% on its earnings in the next year as well, investor would want the company to keep all the earnings as retained and do not distribute any dividend if the ROI is greater than cost of equity. Reverse will be the situation if the ROI is less than cost of equity. We will discuss about it later. Okay. Now let's come back to our formula. I told you that Walter's model is dependent on this method, the perpetuity method. Market price is equal to earnings per share divided by rate of interest. So, for example, 100 rupees is something that I am investing, and if I want 10% rate of return, that means I will get 10 rupees every year. That is what my expectation is. My expectation is company should earn 10 rupees every year at 10%. And if this happens, the market price will be 100. But in reality, what happened? Earning per share was 12 rupees. Company earned more than what I... No. Let's just change the figures because we have to show that the company's return on investment is 12%. So we will just change the figures. On 100, 12% will be 12 rupees, DPS 3 and retained earnings will be 9. Okay. Now coming back to this point, in actual the company earned 12 rupees. My expectation was only 10 rupees and the share price will go up to 120. Why the share price jumped from 100 to 120? Because earlier my expectation was that the company should earn 10 rupees at 10%. So the market price was like somewhere like 100 rupees. But in actual, after a completion of the year, we found that the earning per share is more than our expectation. And if the company can earn 12 rupees at 10%, the share price should be 120. So what happened? The demand for this share shoot up in the market and it went from 100 rupees to 120. Who decides the market price? Tell me one thing. Who decides the market price? Investors decide the market price. Their expectations decides the market price. The higher the demand for the share, the higher will be the price. So that's why the price went up to 120. So you are getting the logic. We are earning 10% on 10% as 12 rupees on 120. And that's why this is the formula for calculating theoretical market price. So if the company is earning 12 rupees at 10% expectation, 120 will be the price. Who decides the market price? Equity. See, you might say that why we are not taking 12% in the denominator. I will just tell you. 12% is what company earned. 10% is what investors' expectation was. Who decides the market price? Company or investor? Investors. So whose expected rate of return should be taken in the denominator? Investors. Because it will be 10% all the time. The numerator will change, and because of the numerator, change in the numerator, the final amount will change. So coming back to this point, market price, as I explained, was nothing but earning per share divided by rate of return. Instead of rate of return, we can put down cost of equity. 10% was the cost of equity. Now, earning per share has two different factors. Dividend per share plus retained earnings. Am I right? I can write it like this also. 3 rupees plus 9 divided by 0.10. Am I right? Instead of writing 12% entirely. Good. Also, retained earnings can be rewritten like this. For dividend per share, I will just write D. For retained earnings, I can write earning per share minus D. Am I right? Divided by cost of equity. 12 minus 3. If you keep the values here or here or here, you will get the same answer. But now, focus on one thing. This is the ultimate expectation of the investor. The dividend that the investor will receive will earn only 10%, will give only 10% to the investor. But the retained earnings that investor is considering here, which is 9 rupees, will give more return than investor's expectation. Let's write down couple of things. 3 plus 9 divided by 0.10. So in order to decide the market price of the company, it's okay to assume that we are going to earn 10% on 3 rupees because that is in our hand cash flow. But it is totally wrong to assume the same percentage on 9 rupees because 9 rupees is still lying with, it is the investor's money, but 9 rupees is still lying with the company and company will earn 12% on it the next year. So considering 9 as 9 is wrong. This 9 is right now with the company, but if the company gives us this 9 next year, it won't be 9 only. Company will earn 12% on that, higher on that. So see, I was earning 10%, company can give me 12%. Basically speaking, company is giving me 2% extra return, which is 20% higher than what I was earning. 2 divided by 10. Getting it? So considering 9 as 9, considering 9 rupees lying with the company as same lying with the investor is wrong. When it comes down to the investor's cash flow, it should be even more because the company will give him more return. So practically speaking, we should incorporate that extra 2% return impact on 9. So what I'm going to do here is 3 plus 1.2 into 9. Why 1.2? 20% higher return should be reflected. So instead of 100%, it should be 20. 100 plus 20%. That means 1.2. I will tell you how. 12 divided by 10 will give you 1.2. See, 10 divided by 10. I am earning 10%. Companies are also earning 10%. The answer is 1. What does that mean? That company will give me the same as I invested. 9 multiplied by 1. So 9 with the company, 9 with me. Okay, but if the company is earning more, how much the company will return to me? 20% more. So 9 into 1.2. This 9 will not be given as it is by the company to me. It will be increased value. So we should consider the increased value, that is multiplied by 1.2. That is the logic behind this, divided by 0.10. So let's write down the formula. Market price is equal to 3 was the dividend plus how did we arrive at 1.2? ROI divided by cost of equity. How did we arrive at 9? 12 minus, or we can say earning minus dividend, 12 minus 3 divided by cost of equity. Can I say this is your formula? This is your formula. Now coming back to this, read it. You can clearly see this is the perpetuity, this is the rate of return, and this entire amount is the annual cash flow. Take it like this. This annual cash flow is represented as earning per share when you talk about equity. This is market price, this is earning per share. This earning per share was divided into two parts. One is dividend, the other side is retained earning. Dividend is multiplied by 10 by 10. Let's say for example cost of equity by cost of equity, because dividend is in our hand. We are going to earn the same rate of return on that. So 10 by 10 is 1 anyhow. That's why you cannot see anything before D. But you can clearly see R divided by cost of equity before retained earnings, because company is earning a different rate of return than the investor's expectation. And this R means the retained earning is lying with the company. So think from the company's angle how they are going to make it more or less. So R divided by cost of equity into retained earnings divided by cost of equity. So this is your formula. Coming over to this, P means the theoretical market price, or you can call it as fair value also. D means the dividend per share. It can be calculated by this formula. I will talk about this formula in a moment. R means return on equity. Return on equity is very simple. Understand? Return on equity is return in the numerator and equity capital in the denominator. Return means your profit after tax minus preference dividend, if any, divided by equity capital, whatever you invest. So it is like this, earning after tax for equity divided by equity shareholders fund. Cost of equity can also be called as required rate of return for the shareholders. Earning per share is nothing but earning after tax for equity divided by number of equity shares. So all these formulas has to be taken. We'll talk about optimum dividend payout ratio later on when the question comes. For now, let's go down and solve the first question of this chapter, security valuation. We'll just start with question number 1. Have a look on this question. We will read it first. Goldilocks Limited was started a year back with equity capital of rupees 40 lakhs. So what you have to do is, first of all, you will need to understand that the equity is involved in it, and then the entire capital investment is 40 lakhs. So we can call it as equity capital as investment. So that much is the investment that we have invested. The other details are as follows. Earnings of the company 4 lakhs. We will assume it as earnings after tax. If there is any information regarding the preference shares, then we will deduct the preference dividend from it. Otherwise, this will be earning after tax for equity. Okay, then the other item which is given to you is the PE ratio, that is 12.5. It is always denominated in terms of times. Dividend paid, the total dividend paid and the number of shares are also given to you. Find out the current market price of the share using Walters model. If you will see, the Walters model looks like this. This is the dividend amount. This is the retention part. This is R means ROI or ROE, return on equity. This is cost of equity. And this is cost of equity. So before moving ahead, you need to understand few things here. First of all, we can calculate the dividend, and it's very easy. Dividend per share is equal to total dividend divided by number of share, which is 3,20,000 divided by 40,000, which comes to 8, right? Then comes the earning. EPS is also easy. Total earnings divided by number of shares. Total earning is 4 lakhs divided by number of share 40,000. So total earning is 10. So we are done with the dividend part, E part and dividend part. Then comes the return on equity. There is no direct information regarding the return on equity. So we will have to calculate the return on equity. So you need to first understand what is return on equity. It's very simple. In the numerator, we will put a return for the equity capital, and in the denominator, the investment in equity capital. So you will understand your return is 4 lakh rupees. If I'm not wrong, the earnings of the company for this year is 4 lakh. That is nothing but the returns to the equity shareholder. And the investment that they made was 40 lakhs, isn't it? So this comes to 10%. This is your first ratio that you need to learn. Return on equity. See, if you open up the formula book, in the formula book, if you come to this part, basics ratios, and on that you will understand the fifth point. Fifth point is return on equity, where we calculate the return on equity by using this method. Profit after tax minus preference dividend, if any. In our question, there is no preference shares, so that's why the preference dividend amount came to 0 and divided by total equity capital. Normally, total equity capital includes paid up value plus reserves and surplus, but there is no separate information as such in this question, so that's why we have taken it like this. 4 lakh rupees in the numerator minus 0 preference dividend divided by 40 lakhs of the capital. So that came to 10% of the return. Okay. The second thing, so we are done with the return on equity. Okay. The second thing that you need to learn is the price earning ratio. Have a look. Price earning ratio, which is 12.5 times. Now you need to understand the concept first. Have a look. We will go from 0. P ratio. Now what is P ratio? As it is said by the meaning of these two words, price means the market price of the share. E, price earnings ratio. Earnings, it means earning per share. What does it say is that what you do is you put a market price divided by EPS. So this is P means the market price, E means the earning per share. Now what will happen if you, let's say, put a market price of 100 and the earning per share of 5 rupees, that comes to 20 times. Now try to interpret this. Whenever you will invest in the market, you will have to pay 100 rupees, and in the very first year the company will earn 5 rupees on your investment. What does that mean? It means that you have earned 5 rupees in a year. You have earned 5 rupees in a year for the investment of 100 rupees. Okay. Then the second part. What is 20 times? What is 20 times? The market price is 20 times. Now if you will relate to this in this manner, 5 rupees is the earning per share, and the market price which is going on in order to buy this share is 20 times the earnings. 5 multiplied by 20. 20 times the earning in the market. So what does that mean is, if you want to earn 5 rupees per share, you will have to pay 20 times of it, which is 100, to buy the share. See, EPS P ratio. Again, we will interpret it once again. If you want to earn 5 rupees, you will have to pay 100 rupees to buy the share, which is 20 times your earnings. 5 into 20 times. So 20 is the times of earning the market price is trading in the market. Market price is nothing but P ratio times the earning. Now, let me take the second example. Let's say, for example, your earning per share is 5. In another company, the EPS is same, but the P ratio is, let's say, 15. So the total comes to 75. Now this is first company, this is second company. This is the earning per share. This is market price. That means the amount that you will pay to buy the share. My question is, which company share you will buy if you want to buy any one company share? Any rational investor would go for the second company. I will tell you why. It's very simple. See, in both the companies, if you compare, you are earning the same amount, but you are paying different for buying the shares. So if the earning is similar or earning is same, why would you pay more for the same earning when you can get the same earning in lesser amount of investment. So anyone would want to invest lesser amount or the minimum amount for the same earning. What does that mean? It means that most of the investors to whom you will ask this question will go for the second option. Means what is the preferable PE ratio? The one which is lower. Higher PE ratio indicates costlier investment or costlier shares. We can say that in order to earn 5 rupees, we have to pay 20 times. But in order to earn the same 5 rupees, you have to only pay 15 times. So this is good, na? The number indicates how much extra you are paying, and any investor would want to pay the least. So the conclusion which comes to here is the lower PE ratio is good. Okay, next question. Now the formula for PE ratio is market price divided by earning per share. On the other side, let's say you are earning something 5 rupees on your investment of 100 rupees. Let's say, okay. So the investment value is called as the market price. You tell me one thing, what is this exactly called for an investor? If you remember when we discussed about this formula, I told you that investor wants 10% of the earning for his investment. So in that formula, this was the market price, this was the cost of equity, and according to him, EPS should have been 10. Should have been. It was 12, that is a different story. But it should have been 10. So, can I say it like this? Just have a look on this. If I am investing 100 rupees and I want 10% on that, then the earning should be 10 rupees. Am I right? So market price multiplied by cost of equity. Can I say it? Cost of equity, required rate of return, should be equal to earning per share. Right, sir? Conceptually, this is right. Then I will just remove this part. What we are going to do, we will transfer the market price on other side. It will look like this, EPS divided by market price. Now you compare this formula and this formula. You will see both the formulas are exactly inverse of each other. In this formula, market price is in the numerator, EPS is in the denominator, and exactly reverse is the case in the second formula, where EPS is in the numerator, market price is in the denominator. Now what you do is, you just convert any one formula into inverse. So when we inverse this, it will look like 1 by PE ratio is equal to EPS by market price. And on this side, KE is equal to EPS by market price. Now you will see this side and this side is same. Right hand side of both the equations are same. That means we can prove 1 by PE ratio is equal to cost of equity. This is how you have proved it, because both are same. So ultimately this comes to the conclusion. Now coming over to our question. In this question, cost of equity is not given to you. If you will see, there is no cost of equity, and at that time what you can do as a last resort to calculate the cost of equity, okay, 1 by PE ratio, 1 by 12.5, you can see it clearly, that comes to 8%. I'm telling you last resort, that means if there are other ways from which we can calculate the cost of equity in the question, then you should go for that first. If there are no other way, there is no other way to calculate cost of equity, then as a last resort, calculate 1 by PE as a cost of equity. Okay, sir. So tell me, did you get all the information which is required in this formula? Right, sir. 8 rupees is the dividend, earning is 10 rupees minus 8 rupees dividend, cost of return on investment 10%, cost of equity 8% divided by cost of equity 8%. If you will solve, you will get a price. I am not going into the calculation part. I hope At this level, you are okay with the calculation. If you're not, then you need to improve your hand on the calculator. So this is the final answer to you. This is 131.25, the market price according to the Walters model. This is the theoretical market price. Understand? Write down or note down below that. This is the theoretical market price. If the actual market price is, let's say, 125, then we will say that the actual market price is lesser than the theoretical market price. This share is undervalued. We should buy it. But if the market price is, say, 140, then if you compare it with the theoretical market price, it is higher than the theoretical market price, right? We will say it as overvalued. We will prefer to sell it. This is the next step. Although not asked in this question, but this is going to be the next step in real life for the investor. After calculating the theoretical price, he will compare it with the actual price and then decide whether the shares are undervalued, overvalued, and correctly valued. And accordingly, he is going to take the decision for buy, sell, and hold. Okay, I hope this thing is clear to you. You have learned about two different formulas, return on equity and KE is equal to 1 by PE in this question. So again, opening up the formula book. In the basics ratios, I told you that I'm going to take these formulas whenever the question will come. So we have done with question number, formula number 5. Also we are done with formula number 12, which is PE ratio. Right? Shall we move ahead? Cool. Have a look now. On question number 2. X Limited earns 6 rupees. So please take your pen and underline this. 6 rupees per share. Above that, write down EPS. Why I am telling you to underline all these things are, this is going to help you at the time of revision. Share having a capitalization rate of 10%. Underline the capitalization rate and write down cost of equity above that. So capitalization rate, required return, and cost of equity are one and the same thing. Why do we call it as a capitalization rate? Let me tell you one thing. The formula for perpetuity was like this: annual cash flow divided by rate of interest. So if 10, let's say 15 rupees is the annual cash flow that we are receiving and the rate of interest is 10%. This means that we are capitalizing 15 rupees by 10%. So this 10%, whenever we divide by something, we basically are capitalizing the numerator with the denominator, with the help of the denominator. So we are capitalizing 15 rupees with 10%. So this 10% becomes the capitalization rate. In the similar manner, when you calculate the market price with the Walters formula, you take the denominator as cost of equity. This is nothing but the capitalization rate. Okay, let's go. So 10% is the capitalization rate, 6 rupees earning per share. Return on investment 20%. So underline this and you can write down return on equity or return on investment. According to the Walters model, what should be the price of the share? See, in this question they are not okay, it is going to be the next question. Okay, let it be. They are asking you to calculate price at 20% dividend payout. Now you need to learn 3 more formulas from the basics ratios. What is dividend payout? See, let's say for example, I am writing it 25%. So if the question says 25% is the dividend rate, it can also say it is dividend yield. It can also say it is dividend payout ratio. Okay, there are 3 different terms which is used. So understand, whenever 25% seems to be a dividend rate, that means it is applied on the face value of the share. Let's say the face value is rupees 10 So on 10 we are going to apply 25%. Let me write it this way. Let's say the face value is 10 rupees. On 10 you will apply 25%, which comes to 2.5 rupees. This is going to be dividend per share. So at that time 2.5 rupees will be the dividend. Okay, but when the question says that 25% is the dividend yield means the return, and return is always calculated on your investment. Investment is always made on the market price. Whenever you want to buy the share or invest in the share, you will have to buy the share at market price, not the face value. So let's say the market price is 100, and of 20% of that, when you calculate 25% of that, it comes to 25 rupees. So in this case, dividend per share will become 25 rupees. But if the question says dividend payout means giving out from where? Earnings, sir. So payout ratio is always calculated on earnings. Let's say your earning per share is 6 rupees in this question, and you are paying out around 25%. That means 1.5 rupees will be your dividend per share. So it depends upon question to question whether they are asking 25% as the rate, yield, or payout ratio. If nothing is given in the question, we are going to assume it as dividend rate. Sir, why you are assuming it as dividend rate only if there is nothing given in the question? See, this is the standard practice which is being followed everywhere, and that's why we are going to assume it dividend rate. There is no other reason behind this. Okay. So this question says that it is dividend payout ratio. We are going to apply it on earning per share. We will get the dividend. If you apply it on the total earning, let's say 6 lakh rupees, then you will get the total dividend. It's very simple. Okay, let's move ahead. And I think now everything is given to us. See, there are few things which is required to calculate the market price according to Walter's model. Dividend, earnings, return on equity, cost of equity, and that's it. So we have the dividend now, earnings also, return on equity, and cost of equity. We have all the 4 figures, and it's very easy for us to calculate. Let's go ahead and do the calculation. Dividend, return on equity, cost of equity. I think, yeah, both are given to us. Then earning per share and dividend. Rest of the calculation will be done by you. I'm not going to do it. See, at this point again, I'm not going into the calculation because I believe you know how to use the calculator, and these are the basic calculations. So that's why I'm not going deep into it. 105 is the price, theoretical market price. You are going to compare it with the actual market price, which can be, let's take an example. The actual market price is 100 or 120. So if the actual market price is 100, then you will say the shares are undervalued. Why? Because according to you, it should have been at 105, and you are getting it at a 5 rupees cheaper rate. So undervalued, you should buy it. And if it is as 120, you will say that, sir, according to me, it should be only 105 now. Why 120? If it is available at 120, it is overvalued, sir. You will sell it. That is what the next step is. Okay. Good enough. Question number 3. Now question number 3 is will give you the will ask you to calculate the dividend payment ratio. The market price is given here. Share price is already given. For the first 2 questions, we have been asked to calculate the share price, but in this question, the share price is already given. What we have to calculate is the dividend payment ratio, as to have the share price at 56 by using Walter model based on the following information. So following information is given to us. We have to calculate the dividend payment ratio. Now, how to calculate the payment ratio? Payment means the payout ratio. So dividend payout ratio is nothing but dividend per share divided by earning per share. Am I right? Into 100. Now you have to first calculate dividend per share. Okay. With the formula. Now, on this side, you can clearly see the net profit is given to us, which is 50 lakhs. Outstanding 10% preference share. Now is the time. Profit after tax, 50 lakhs. Preference dividend. How much is the preference dividend? 10% into 80 lakhs. See, 10% into 80 lakhs. 8 lakh rupees will be paid as preference dividend, and then 42 lakhs will remain for the equity shareholder. Okay. Number of equity shares, sir. 5 lakhs. This will give you earning per share 8.4. So you have the earning per share also right now. Okay. Then this is R, this is KE. See, the formula is this. Now you have this price which is 56, dividend you have to calculate, cost of equity is given to you, and return on investment is also given to you. Now you need to solve this question. That's it. The equation should be solved and you will get the answer. I'm solving it on a different page. Have a look. Am I right with the formula? 56. Dividend we don't know yet, plus return on investment 15 and 12. It's very easy now. Earning per share 8.4, dividend is not known yet, divided by 12% or 0.12. So take the 0.12 in the denominator on the left hand side. It will be multiplied with the 56 figure. It goes to 6.72. Dividend plus 15 by 12 into 8.4. That's 10.5, and 15 by 12 will be 1.25 dividend. So this is your equation. By solving this equation, we will get the figure of dividend. Okay. I will transfer this 10.5 on this side. 3.78 negative is equal to minus 0.25 dividend. The negative sign on both the side will get cancelled automatically. Dividend will be 3.78 divided by 0.25, that's 15.12. Now comes the dividend payment ratio. Dividend per share divided by earning per share. Dividend per share is 15.12, earning per share is 8.4. If you do the calculation, it comes to 180%. According to Walter's model, this is not practical because you cannot pay, your earning is 8.4. How you can pay more than that from 8.4? How you can pay 15 rupees from 8.4? So practically this is not possible. So they have given this. According to Walter's model, this is not possible. Dividend payout ratio would be 0 as payout is more than 100%. 1.8 means 180% of EPS, which seems to be illogical. Now, what is the conclusion that you should take from this? There might be some problem in the question itself. No, sir, there is no problem in the question. The institute wants to test your knowledge of how you are going to write in such situation. So whatever the question is, even though it seems to be wrong to you, you need to make sure that you solve that question in order to fetch the marks. If the institute is giving you the wrong question, you should attempt it in order to take the marks from the institute. Institute will not give you any marks if you are not attempting the question which seems wrong to you. Are you understanding? If you skip the question by saying that the question is wrong, you will not get the marks. You have to solve it. Anything but solve it. Okay. That's it. Question number 4 is going to be our next question. Have a look. Summit Limited, an all equity company, has a profit after tax of 300 crore and 15 lakh shares of rupees 10 each. Underline this, write down PAT. Underline 15 lakhs, write down numbers of rupees 10 each. Underline 10, write down face value. It is face value. Outstanding at the end of financial year. Its cost of capital is 13%. Put an arrow for 13%, write down KE. Rate of return, put an arrow on 17%. What is this? ROI. Am I right? Ascertain the value of the company. They're not asking you the value of the share or price of the share is not asked to you, they're not asking you to calculate the price, they are asking you to calculate the value of the company, which is price multiplied by number of share. Okay. Under Walter's model, if the payout ratio, underline payout ratio, write down DPR, which is nothing but uh, dividend per share divided by EPS, or in other manner we can write it down like this: dividend per share is equal to DPR into EPS. If you apply it on the earnings, you will get the dividend. And the ratios are 15, 30, 60 and 90. So different types of payment ratios are given to you, dividend payout ratios. You have to find out what is the value of the company in each case, and then you will have to draw out the inference from the values obtained under different cases. You will have to come to the conclusion comparing all those 4 different payment ratios. Okay. And this question is very simple. This will be solved by me here. Question number 4. Have a look. If you want to calculate market price of the share, you will have to take dividend per share plus return on equity, cost of equity, then earning per share minus dividend per share divided by cost of equity. But if you want to calculate the market value of the entire company, understand, with the same formula, you will have to take the entire dividend, not just the per share dividend, plus R by K in bracket entire profit after tax, not just per share, minus dividend. So the formula is same. The only difference is the figures in here are per share basis and the figures in here are in total basis. Okay. Now we have the formula ready. Let's say the first thing, dividend payment ratio is, they are saying 15%. So if we apply this 15%, we will get the value as 300 crore is the profit multiplied by 15%, that means 45 crore, plus return on investment 17, cost of equity 13, profit 300 minus dividend 45 divided by 13%. So if we solve this, we will 300 minus 45 into 17 by 13 plus 45 divided by 0.13. You will get the value of 2911.24. Now if you will see, one calculator trick is that you can save the time in your exam by directly calculating the final answer from this step. Don't write 300 into 15% is 45 here. You are wasting the time by writing 45 here. You are wasting the time by writing this part also here. Because final answer is going to be this and institute is going to check this only. So in between, if you will just waste your time by writing the steps, you will not be able to complete the paper. Now what I did is, I knew that there is something in the bracket. So I started from this point. On the calculator, if you will see, I did 300 minus 45 multiplied by 17 divided by 13 and then added this 45, directly 45 on the calculator, because I knew on without calculating also that this is going to be 45. So and when I did all these things, whatever was the result on the calculator, I divided it with 0.13. I got the answer in one stroke. Okay. Now what you have to do is, you just have to replace the dividend payment ratio from 15 to 30, 60 and 90 and you will get different answers. Now I'm not doing the calculation, I'm just coming up here and showing you the answers. This is the first answer, 2911. Then if you increase the dividend, have a look what is happening. If you increase the dividend payout ratio, the value has decreased from 2911 to 2804. You increase the payment ratio even further, the value will decrease even further, and this is going to continue till the time you increase the payment ratio. This is what is written here. Decision: with the increase in payout ratio, the value of the company is decreasing. Write down couple of things ahead of that also. Take a pen and in compiler itself. because ROI, which is 17%, is greater than cost of equity, which is 13%. That means company is a growing company. Why growing company? Because they are giving you more return than your expectation. Hence, optimum dividend payout is 0%. If we follow the 0% payout ratio, the market value of the company is highest at optimum dividend payment ratio. Just the shortcut. So just write it down, and now I'm going to explain the same thing to you. Why is this and what is optimum dividend payout ratio? See, there is one mistake which is given, which is there in this answer. Not a mistake, there is one silly thing which has happened. First, the answer calculated earning per share. So they divided 300 crore by 15 lakhs to arrive at 2000 rupees. Okay. And then at the end, they again multiplied the final answer with 15 lakhs. So first you wasted time in dividing by 15 lakhs, then again you multiplied it by 15 lakhs. So to any figure, if you divide it by 15 lakh and then multiply it by 15 lakh, you will get the same answer. Then why to do all these things? Why not directly we can take the figures in crores? It will save a lot of time for you. Okay, so just remember that. Now I will conclude this question, but we are going to discuss the optimum dividend payout. Then when to say the optimum dividend payout and why the market value of the company is decreasing when we are increasing the payout. So have a look on this part now. What happens is, let's say this is return on investment. This is cost of equity. This is, let's say for example, the company is earning 12% return and the cost of equity is 10%. Okay. Now what is the meaning of that? This is what the company is earning on your money, and this is what you are expecting from the company. So can I say in this situation that the company has earned more than your expectation? Right. So here ROI is greater than cost of equity. We will call it as a growing company. Okay. This is a growing company. Here, do you want the company to pay dividend? No, because if you let the company retain all the profits, it can earn 12% on that retained amount. But if it pays you the dividend, you will be able to earn only 10% on the same amount. When you know someone else can earn more on your money, you would want him to keep or it to keep the money with itself, the company. So here you would want the company to pay 0% dividend, means 100% retention, right? So this is what the investor is expecting. Investor is expecting not to pay any dividend in the market, and if the investor's expectations are followed, I told you the market price is driven by the investor. Okay, investor's demand and supply. So if you fulfill the investor's expectation, the market price will be highest at that dividend payout ratio. So this is called as optimum dividend payout ratio. Why optimum? Because if it is followed, the market price will be highest. And now in this situation, if the company moves away from this particular percentage to any percentage, 0, 1, 2, 3, 4, 5, 6, 90, 70, any percentage, the market price will start declining. Let's say another example, the 12% is the return on equity, and your cost of equity, your expectation from the company is 15%. Now here you would want the company to pay whatever they have earned as dividend, because you can earn more on the same amount which the company is earning only 20%, where the company is earning only 12%, sorry, not 20, and you can earn 15% on that. At that time, return on equity is less than cost of equity. The company is a declining firm, not the growing firm. It's a declining firm, and here you would want that the company should return all the earnings and pay all the earnings as dividend. So optimum dividend payment will be 100% here. This is what the investors are expecting, and if the investors' expectation is fulfilled, the market price will be highest at this dividend payout ratio. Now, if you follow 0% dividend in this case, the market price will be lowest. 0% in this case, the market price will be highest. 0% in this case, the market price will be lowest. So it is not about the percentage, it is about the situation and what is the optimum at that time. If we follow the optimum, the market price will be highest. On the vice versa, it will be lowest if you follow exactly opposite of that. Now, if the return on investment is 12% and your expectation is also 12%, at that time, there is no dividend payment. There is no optimum payout ratio. You pay any amount and the market price will be indifferent. Means it will not change at any percentage of dividend payment ratio. You pay 0%, 20, 30, 50, 80, 90, 100%. The market price will remain same. Okay. This is the logic of optimum dividend payout ratio. You can use this logic, try certain example, and you will see this working. Okay. We can clearly see it working here. In our question, return on investment was 17% and cost of equity was 13%. Here ROI was greater than cost of equity. Company was earning more than investor could. Okay, so in this case, optimum dividend payout ratio was 0%, and the company kept on increasing payout ratio. That means it was going against the optimum payout ratio, and that's why the market value started decreasing. At every payout ratio, next payout ratio, the market price decreased because it was going far from the optimum. See, 90% is far from 0%. That's why the market price is low here, 2378.70 crore. This is the logic. Coming over to the formula book, this is the same thing that is given here, and I told you that we will take it later on. Have a look on the page number 8. You can clearly see it here. When ROE is greater than cost of equity, company should retain all the earning. Optimum dividend payout ratio 0%, and our market price will be highest at that optimum payout ratio. If return on equity is less, that means company is earning less, it should distribute all the earnings, 100% dividend payout ratio, and at that market price will be highest. If both are same, it doesn't matter, and the market price will be indifferent. Okay with this? Let's move on to the next question. I hope you understood this. Now coming over to this question, this is going to be your homework. See, you have to calculate the market value per share according to the same formula, first of all. Then you will have to tell what is the optimum dividend payout ratio according to Walters model. It is clearly written over here, capitalization rate KE, ROI. So ROI is greater than KE, optimum dividend payout ratio should be 0, right? And the value of the company share at that payout ratio. So keep 0 as dividend and calculate the market price again. You will get the answer to that. I'm just skipping this question. Coming over to this question, question number 6, have a look. There are 2 more questions that we have to discuss, and then I think we are over with this concept of Walters model. The following information is supplied to you. Total earnings, you can clearly see 2 lakh rupees. Number of equity shares of rupees 100 each, 20,000. Okay. With this, you can calculate EPS, I think. Right? Have a look. EPS is nothing but total earnings, which is 2 lakh rupees, divided by number of share, which is 20,000. So we have the EPS figure with us. Dividend paid, we can calculate the DPS also. The total dividend paid is 1,50,000 against the 20,000 shares. So 7.5 will be the DPS. Okay. Price earning ratio, you can clearly see it is 12.5. With the help of that, you can calculate the actual market price, which is EPS multiplied by PE ratio, which is 10 multiplied by 12.5, which goes to 125. So these are some real figures derived from the table given to us. Okay. Ascertain whether the company is following an optimal dividend policy. In order to find out whether the company is following optimal dividend policy, we need two figures: return on investment and cost of equity. And if you will remember, the same figures are not given to us in the question. We will have to calculate that. Okay, good enough. Return on investment is nothing but return divided by investment. Am I right? What is the return? 2 lakh rupees. And where is the investment, sir? Investment is the equity capital. And you can calculate the equity capital. Face value 100 rupees, number of share 20,000, it goes to 20 lakhs. I understand it should include reserves and surplus also, but the same is not given in the question, and that's why we are not including it. So 2 lakh by 20 lakhs, ROI comes down to 10%. I also told you in the first question that when there is no other information for cost of equity, as a last resort, you can calculate cost of equity with this formula, which is 1 by 12.5, which is 8%. Now you tell me, you can clearly see that the return on investment is higher than cost of equity. Means company is earning better than the investors. Investors would want the company to retain all the profits. Means the dividend payout ratio should be 0%, optimum dividend payout ratio. But you can clearly see, out of 2 lakhs, the company has paid 1,50,000 as dividend, which is 75%. Optimum was 0%, actual is 75. Whether the company is following optimal dividend policy, the first answer should be no. The company is not following optimal dividend policy because ROI is 10, give the calculation, KE is 8, give the calculation. According to that, optimum should be 0%. Okay. Also, along with that, you should calculate the market price at optimal dividend policy. So they have given, I think here, with the current data, that is 7.5, with the current data that they are following, 7.5, they have calculated the market price, which is 132. But if you follow the optimum dividend policy, then the market price comes down to 156.25. So they have calculated the market price in both the case with 75% dividend ratio and 0% dividend ratio. Second question, find out what should be the PE ratio at which the dividend policy will have no effect on the value of the share. Come down to the formula book. Question says that what kind of dividend policy have no impact on the value of the share? This means if this is the scenario of your dividend policy, then there will be no impact on the market price. That means ROE should be equal to cost of equity. We can clearly say that in order to have no impact on the market price, ROE should be equal to cost of equity. And ROE is 10% in our question. That's why cost of equity should also be 10%. But the question is not asking you, understand this thing, question is not asking you what should be the cost of equity. They are asking you what should be the PE ratio. So if cost of equity should be 10%, we can say that cost of equity is equal to PE ratio 1 by 0.10 is 10 times. Then PE ratio should also be, we can just write it like this. PE ratio is equal to 1 by cost of equity 1.10 10 times. PE ratio should be, now going it in a straight manner. We calculated everything in a reverse manner. Now going forward, first step is to calculate the PE ratio. If PE ratio is 10, then automatically cost of equity will become 10%. Then automatically ROE will be equal to cost of equity. And in this case, market price will have no impact. So, last step was given to you that market price should not have any impact. This is possible only when ROE is equal to KE. ROE of 10% is given to you. So second step is KE should be equal to 10%. Now, for KE should be equal to 10%, PE ratio should be 10 times. So this is your first step. Then this is second. Then this is third. And then automatically this is fourth. Getting it? Okay, sir. Okay. Last. Will your decision change if the PE ratio is 8 instead of 12.5? If the PE ratio is 8, the cost of equity will become 12.5%. ROI is only 10%. Now we can say that ROI is less than cost of equity. ROI is less than cost of equity. Investor would want the company to distribute entire dividend. That means 100% will be the optimum payout ratio, and still the company is following 75%. You have to give the market price at 100% dividend payout ratio in the last answer. So at 100% dividend payout ratio, let me just check. At 100% dividend payout ratio, this is dividend, this is 10 minus 10, 0. Or everything has been paid, so nothing is retained. So retention is 0, dividend is 10. But in this case, it was retention, dividend was 7.5 and retention was 2.5. So in the previous case, it was 76 rupees the market price. When we follow the optimum payout ratio, we get a higher price, which is 80. Okay. I think now this question is similar. I'm going to give it as a homework. Question number 7, take it as homework. Question number 8 is what we are going to solve. Now, I think 8 and 9 will be homework. 8 is the last question that we are solving, so focus on this now. This is something which may or may not be asked in the question because this includes a concept from mathematics. Okay, let's first read the question and then we will see where we get stuck. X Limited has an internal rate of return of 20%. So underline 20%. This is nothing but ROE, or you can say ROI, or simply we can write R, return on equity. It has declared dividend at 18%. This is, underline this and write down rate, because nothing is given near to 18%. They are not saying 18% is rate. They are not saying it is payout ratio. They are not saying it is yield. So when nothing is given in the question, I told you the standard practice is to assume it as rate, and rate is applied on the face value which is given over here, right? So the first thing is R 20%. The second thing is dividend per share is equal to face value into dividend rate, which is 10 into 18%. So dividend per share comes down to 1.8 rupees. Okay. Now they have also given you the payout ratio. So dividend per share is equal to earning per share into dividend payout ratio. This is the formula. You have already calculated the dividend per share. Earning per share is something unknown to us, and the dividend payout ratio is 36%. If you solve this, you will get the earning per share as 5 rupees. Okay, so there are multiple figures that we have already arrived at. %, dividend per share and earning per share. Okay. What else? Price earning ratio. See, they have given us with the figure of PE ratio. So market price is equal to PE ratio into EPS. PE ratio is 7.25. EPS we have just calculated. The market price then comes to 36.25. This is another calculation that we have arrived at. So market price is also given to you. They are not asking you to calculate the market price, right? Find the cost of equity. This is what we have to do in this question. We have to find out the cost of equity according to Walter's model, and hence determine the limiting value. Underline the limiting value and write down lower limit and upper limit. minimum and maximum. Can you calculate the minimum and maximum? Minimum and maximum price of the share? Yes sir, we can calculate. If we follow optimum dividend payout, the maximum price can be achieved. And if we follow exactly opposite to the optimum dividend payout, minimum price will be achieved. So lower and upper limit will be calculated later on by us. Okay. Now, let's go ahead with the formula. I will just take the answer from here, not to waste the time. This is the Walters formula, and you start putting up figures here. You have the price 36.25, you have the dividend, you have ROE, you have earning, dividend. The only figure that you don't have in this entire equation is the cost of equity. You start solving the question step by step, and you will reach at this point. From this point, my answer will change, and that is what I am going to write down here itself. I would also suggest to write it down here. Change means a step only, just a step. So what I am going to do after this step, I am going to take all the figures on the right hand side to the left hand side. So it will look like this: 36.25 KE square, because there are 2 times KE, minus 1.80 KE minus 0.64 is equal to 0. Now what happens is you get stuck at this point and you don't know how to solve this equation, how to take this equation to the next step. This is where the mathematics comes in. This equation is exactly equal to ax square plus bx plus c is equal to 0, where 36.25 is equal to a, minus 1.80 is equal to b, because we have plus b. So b, the value of the b is not just 1.8, it is minus 1.8, and minus 0.64 is equal to c. So we came to the conclusion that this is exactly equal to this equation, and this equation is called as quadratic equation. And in mathematics, this equation can further be converted into a formula which we will use for solving the problem. This is like it, where x is nothing but the cost of equity. So x is equal to, have a look, minus b plus minus under root minus b plus minus under root b square minus 4ac divided by 2a. See, minus b plus minus under root b square minus 4ac divided by 2a. Now you start keeping the values here, and this x is nothing but the cost of equity in our case. This is how we are going to find out. Okay, so what is minus b? Minus to keep it intact, but if you take the figure of b, b is minus 1.8. So I am going to write down minus 1.8 in place of b. So this is how it will be: minus and in bracket minus 1.8 plus minus under root minus 1.8 square minus 4 into 36.25 into minus 0.64 divided by 2 into 36.25. Now if you take this equation further, it will give you some figures. This is 1.8 plus minus 1.8 square 3.24 and just a second, 36.25 into 4 into 0.64 plus 92.8, 1.80 square, 92.8 square root comes to 9.8. So if you will solve that entire thing, it comes to 9.8. This is 72.5. Taking further from this step, plus minus means there are two different answers for this equation, one with the positive, one with the negative sign. So we will write it down like this: 1.8 plus 9.8 divided by 72.50 or 1.8 minus 9.8 divided by 72.50. And if you will solve this, you will get 16% here or minus 11 point something 03% here. Have a look. These are the two answers for cost of equity. And here we will clearly write down that cost of equity cannot be negative, and hence we will ignore this part and we will continue with cost of equity as 16%. See, cost of equity 16% if you will solve this. Alternative method is also given to you. So all in all, you will have to remember the formula of quadratic equation. No other answer to this. So if you want to write down, you can just do it by pausing this video. I will move ahead. I hope you understood this question. There are very less chances that this equation will be asked in the exam, but still it is a part of the syllabus, so you never know what happens. Okay, there are many other things to focus on. Now, have a look. ROI is 20%, cost of equity is 16%. Okay. In this case, what we are going to write down that since ROI is greater than cost of equity, optimum dividend payout ratio will be 0%. So what we are going to do, we are going to calculate highest two limits. Upper limit means the highest price which will be arrived at 0% DPR. So let's calculate the market price. Zero dividend payment ratio means the entire amount will be retained as earnings. And what was the earning per share? Earning per share was 5 rupees. Okay. So dividend plus ROI KE in bracket earning minus dividend by KE. Dividend is 0, ROI 20, KE 16, entire amount 5 as retained 0.16. So you will get an answer. It comes down to 39.06 rupees. This is the highest value. And if you go for the lower limit, you will have to follow exactly opposite to the optimum dividend payout ratio. So here we are going to distribute 100% as the dividend. So 100% dividend means entire 5 rupees will be the dividend plus 20 by 16 in bracket 0 because 5 minus 5, 0.16. So 5 divided by 0.16 comes to 31.25. See, if you follow 0%, the market price is highest at 39.06. If you follow 100%, the market price is lowest at 31.25. These are the limiting values. Limit means the upper limit and the lower limit. See, 31.25, 39.06. Got the answer? Shall we move ahead? This is going to be your homework, question number 9. So with question number 9, we finish all the questions of Walter's model. Out of 131, 9 questions was there on Walter's model. Now question number 10 is going to be on the Gordon's model or dividend growth model, which we are going to discuss in the next lecture. So again, there will be a new concept based on the same thing, which is perpetuity. But this is going to be an interesting concept where there will be certain complexities involved in the question, because till now I think the questions were little easy. Okay, pretty easy. Last but not the least, all the 9 questions are not important from the exam point of view, because this is CA final, first of all. Second, these questions were asked in old syllabus earlier, like it was there in the old syllabus, but CA final only. But later on they included in the new syllabus also, that's why we took it. But I didn't find any question that they have asked except for the optimum dividend payout, like this one, I think, or a particular question with the optimum payout ratio detail. Just let me check once again. No. So these question, all in all, what I want to say is not that important. So don't focus on it from this point onwards. Just a single question you can mark, a couple of question you can mark as important. I will just tell you. You can take question number 8 It is a good question. It covers most of the things. If you are able to do question number 8, it includes the Walters formula also and these details also. So question number 8 you can mark as an important one, and question number 6. And question number 6. So question number 6 and 8 should be marked as an important. Out of rest of the you don't have to do any question out of the rest of the 7 questions. So from 9, 6 and 8 is the important one. You can skip the rest of the part. So I will meet you in the next lecture with a new concept. Bye bye till then.